Glorious day, very glorious. You see someone in this picture, if you're watching on YouTube, is irresponsible, doesn't take care of his tie knots, just really inappropriate, generally speaking. It obviously would never be me because I'm always polished,
You're always
on
wearing a
point.
tie, right? Like right now.
Yeah, exactly. Well, big executives like me don't have to wear ties all the time necessarily.
Yeah, you don't look like you go to an office. You look like you own the office.
The duck may sit in the lake, but my daddy owns the lake. All-time holes reference, if you know, you know. But with that said, welcome to the show, the Lone Star Capital Podcast. Craig McGrouther right here speaking to you live. You're going to be listening to this recorded, so it's not live for you, but the Director of Business Development with Lone Star Capital, structuring all the equity for the opportunities alongside the CEO. Why don't you change your title there, Rob, please, to CEO of Lone Star Capital? Not just Lone Star Capital, CEO, Chief Executive or Chief Operating.
Kind of like everyone else on LinkedIn.
Yeah, the CEO of their imaginary company. You
Mm-hmm.
actually, real quick, this is a fun little intro here, so I'm enjoying this. But you actually went to LinkedIn the other day, didn't you? And you were really liking what you saw, correct?
I don't typically like what I see. I feel like people on LinkedIn, it's a
I was
little bit
being
of a
facetious.
cesspool. Yeah, I know you're being facetious. It's a bit of a cesspool, and it's like everyone's very self-righteous. And let me tell you about this thing. And
3 ways to do
yeah,
something.
I,
Emoji, another emoji, a different emoji.
right,
Hmm.
exactly. Yeah,
Yes.
picture with me and my wife and kids, and be like passive investing. I can spend more time with my kids.
Yeah, it's not really your shtick. There's also some people too. I've seen that, particularly the one person who we don't work this person. He's a competitor. So if you're one of our friends, it's okay if you do this. If you're one of our capital partners, we love you. But there's one person in particular that it's always the punching bag in my commentary. I take issue with him, even though he's never done anything wrong to me personally. But it seems he just kind of click farms his wife all the time on LinkedIn. Interesting move. Not really what I would do personally. But hey, it's all good. It's all good. So I'm not calling out any of my friends, anyone I'm directly in contact with. So don't think that you're being called out. I'm not subtweeting anyone, if you will. But yeah, we got a fun show for you today. But let's get into it real quick. First things first, I wanted to actually do a little housekeeping. Conferences. Many people are asking, Craig, you go to NMHC? Rob, you go to NMHC? Are you going to I'm in Laguna, which just happened a week ago? Well, obviously, no. But no, we're not going to NMHC. We're going to go to 2 conferences coming up. Raise Fest in Phoenix and Best Ever Conference in Salt Lake City, coming up about 2 weeks after that. So Raise Fest in Phoenix, our good friend Hunter Thompson will be hosting it, of course. 1,000 people will be in attendance, hundreds of capital raisers. So if you're going to be at Raise Fest in Phoenix and you listen to this, please reach out to myself. We can set up a meeting. If, in fact, you're a capital allocator looking to bring dollars our way to our deals. And then, of course, similarly, same theme, same thought. If you are going to Best Ever Conference, March 3rd to 5th in Salt Lake City, similarly, we want to meet with you, and you might even get taken to dinner. So that's the best. We want to do that good stuff. So we look forward to connecting with you in person there at those 2 events. There's to be some other fun stuff that we're actually working through right now as we speak in reference to more events here coming up in 2025. I feel like we're going to blink and Q1 is going to be over. But with that said, big events coming up here. Best Ever Conference, Salt Lake City. Race Fest before that. You'll be in Phoenix here coming up as well. So looking forward to all that good stuff coming up here. It's my Super Bowl. I get to meet and be with a lot of people I've met online, a lot of friends in the space. And, we will break bread, have good meetings, share notes, tips, and what we're working on. And hopefully we'll have a deal at that point. Unfortunately, we don't have a deal right now. We're actively raising for. The market is slightly broken. We'll get into that in a second. But before we get into the meat and potatoes of the show, also, once more, our referral reward program. There's still so many of you that I haven't talked to that maybe listen to the show. I get it really like an email a week saying, hey, listen to the show, want to connect. I don't know why I haven't been prompted to reach out to me before, but please do. If you have any kind of thoughts, want to know more about Lone Star Capital, if you want to work with us, the email is Craig, C-R-A-I-G at lscre.com. Once more, C-R-A-I-G at lscre.com. But real quick, referral reward program. If you are an investor or you know anyone that's looking to invest in a multifamily opportunity, we will pay you $2,000 per referral fee at closing at the time that someone, in fact, invests with us in a deal. And then if you're a fund manager who knows other fund managers who might be interested in what we're doing, we will pay $5,000 for that. If you're a fund manager looking to or know someone that's looking to bring capital to deals. And then finally, if you have a 1031 exchange investor, we will pay you a whopping $10,000 to place the capital, assuming that we close the deal, all that good stuff. Do you want to go through any additional fine print there, or did I cover it okay?
I hate to be a Debbie Downer, but I think we changed the 1031 exchange referral fee to 5,000. But who knows? Maybe that'll change. But if you heard that on this podcast, maybe you can say, "Hey, I heard Craig say on the podcast it's 10,000."
Yeah, comes out of my paycheck, right?
Yeah, exactly.
Yeah, good. I'm already writing checks for my future self to cash. I love it. Awesome. Well, so some fun stuff here. I think I actually want to start in a little bit different of an order in which you initially had, but what I want to start with is 2025 Q1 expectations for acquisitions. So as we stand right now, I hate to be the bearer of bad news, but we're kind of in a broken market. What do I mean by that? Well, due to the Treasury running up and cap rates not expanding, we are in a situation where basically no deal makes sense right now, unfortunately, which is a problem. So, in my opinion, we're kind of in a broken market. And let's say if we want to close a deal in Q2 of 2025, we're in Q1. Well, we need to lock that deal up today or around this period of time because these deals, they're big aircraft carriers. They take a while to move. They take a while to size up, due diligence, the whole nine, the capital raising process. Depending on the structure of the deal, if it's a tax exemption opportunity, it's probably a 90 to 120 day process. And if it's normal market rate deal, it's probably 60 to 90 days. But as it stands right now, we have nothing in contract. It's the end of January. This is coming out, I believe, on the 27th or so. So we're looking at the calendar and just being practical here. And we're in a situation where the market's just really broken and deal flow, I think, will go down as historically slow in the first half of 2025. Be curious to know your thoughts there. As I said, I think the market is broken. So from an expectation perspective, if you're a capital raiser, if you're an investor chomping at the bit to get involved in the deal, they will come. They will be really good deals this year, but it's going to be slow.
Yeah, I guess you could say I was a little bit wrong because I felt that 2025 was going to bring more deal volume than 2024. But we'll see. If the market doesn't get into gear, I could be wrong about that. I still think I'm going to be right, but I think it's going to be just very loaded into the back half of the year, just because, like what you said, really closings are a reflection of market activity from 3 months prior. So when you're looking at Q1 closings, you're really talking about what was going on in Q4 of 24. And there was absolutely nothing. Well, not nothing, but there was very little going on.
Actually, a lot went on, all to the detriment of our business and our space for sizing up deals.
Well, sure. As far as news, there was a lot of things that were newsworthy. There was an election. There were big rate movements. But as far as transaction activity, or at least deals getting put together, not much. And then same thing now it is only the first 24 days of the year. And the new administration has just taken over this week, which I think what I was going to say is there's a lot of excitement about the Trump administration, about the new America, new economy and growth, and kind of people are tired of this slump. I was talking to my uncle, who is a rare watch dealer, watch expert, and he has a very vast network of high net worth, ultra high net worth individuals that are in the watch
luxury niche products. Yeah,
exactly.
They're not cheap.
So like the watch business is funny and eerily similar to the real estate business because illiquid assets, it lags the stock market. And the conversations that he's having recently with people across various industries is that there's a lot of excitement. There's a lot of capital that wants to go to work. There's a increased interest in luxury goods. So he's talking watches, he's talking luxury handbags and things like that. So I think that this is kind of the start of the economy perhaps wanting to wake up and get going. That doesn't mean prices are going to go anywhere real fast, but it just means that there's the push for it to start. And so in terms of our business and in terms of transaction activity, you said it from the very beginning, the key is rates, because cap rates are quite sticky. And because there's just a demand of capital, cap rates aren't going to blow out so that everyone can buy on positive leverage. It's just not going to happen. So basically, the real estate world just kind of has to wait it out until treasuries come in to a level where it's compatible with people's underwriting. So, and where is that level? Well, as you're seeing on the screen that Craig is sharing, the 10-year US Treasury yield is 4.63 today on January 24, and we really need treasuries to be 4% and less. Ideally,
on the 10-year, and ideally lower, right?
yeah. If the 10-year goes to 3.5, it's going to be a bonanza. But we definitely need it to be below 4 to unfreeze the market.
So let's just unpack this a touch more. So when rates get cut, what's usually getting cut is this note right here, term SOFR. So if you look at floating, the floating section of this, there's the treasuries, the swaps, and then the floating, right? So if you go to term SOFR, when rates get cut, that's what's getting cut. So some misnomers here. If you're a fixed rate borrower, what you're doing is an equation simply like this. You go to the treasury note, right? So we like 7-year term. I think 7 years is a really nice blend. 5 years of yield maintenance, meaning after 5 years, there's a small, modest prepayment penalty. Maybe you're a 5-year borrower, right? But typically speaking, you have a lender spread somewhere between 180 basis points and 2 basis points, right? So it's a simple equation.
200.
Yeah. So yeah, exactly. So let's just call it, for a round number, a two full 200 basis points as your lender spread. So take that 7-year term, take that 10-year term, take that 5-year term, whatever you want to do, right? And then you add that plus 200, right? Well, that would put your debt, if you're taking 7-year debt out today, if you're to fix and lock today, that would put your debt at 6.5%. Cap rates in good markets are probably mid 5s right now, maybe lower. If you're Dallas, maybe lower. So you mean to tell me that you're going to fix in rate lock for a 5 or 7-year term here, where maybe your yield on cost barely gets to 7%. You can barely get to, a positive yield on cost here, right? It would take you a long period of time. That deal just doesn't make sense for a lot of people unless you're putting a substantial amount of cash down. But it just really makes deals not work right now. That's why I said it, and kind of led with the fact that the market is kind of broken, unfortunately. So it's tough. And then if now, naturally, what got a lot of people in trouble, but is probably the only way deals will actually work in today's environment, is actually, in fact, floating. And this is a very nuanced conversation. There's, situations that work today will not work tomorrow, and vice versa. But right now, what you probably want to do is lock in, with a lender spread, something plus, term SOFR right here. So what would you say normal, when you do a floater, Rob, what does that kind of spread plus term SOFR kind of look like? Is it two whole 200 basis points, 2 points? Is it that? Is it a little bit 2 and some change? Where does it usually lock in?
Yeah, it's typically a little bit more than fixed rate equivalent. But for the purposes of this conversation, you could just say a 200 basis point lender spread on a floating rate agency loan. So if you're looking at term SOFR on the screen, it's 4.32. You add 2 points to that, you're looking at a 6.3% interest rate, basically. And that's your starting rate. And it gets readjusted every single month based on what SOFR is, which is directly correlated to the Fed's movements. So
when the Fed cuts rates, that goes down. I just want to make that very clear, because so often people say, oh, the rates were cut and you're a fixed rate borrower. Oh, well, debt must have gotten better. Well, actually, sometimes when rates get cut, the treasury numbers run up a touch. So it's a little bit counterintuitive. It's a little bit kind of frustrating, and it's slightly convoluted. But this is kind of why I said the market's in a touch of a lull right now. And this is going to take some time to work out. I think when Trump got elected, it was very clear that the treasury notes ran up because they found Trump to be more of a spender, more inflationary. So this is kind of the tough situation that we're in right now that we're having to work through. So yeah, I don't know where this goes, how you make deals work right now. We've been very fortunate that we've got our tax exemption route where we're preserving affordability. We're getting a wider cap rate at part closing, create a little alpha there. But outside of those deals, very little makes sense. So very fortunate that we have been able to transact been able to do deals, been able to be active and really an otherwise very slow and difficult point of the market cycle. And this is kind of healthy. This probably had to happen. Things got too hot. The term SOFR was at basically 0% for a very long time in the ZIRP environment, zero interest rate period. So this is the working out of that. And, gains are being lost. There's more and more groups now that are unfortunately, doing capital calls. A lot of equity getting evaporated. A lot of people who can't raise for, pref infusion capital calls will have the properties get turned over to the banks and whatnot, or will have to just basically forced to sell, maybe potentially evaporating most or all equity in deals. Some people would be lucky just to break even, unfortunately. So that's kind of the point where we're at in the market cycle. And as long as treasuries and SOFR stays high like this, the longer it does, the more evaporation of equity will occur, and the more kind of unfortunate realization of losses will in fact occur here coming up. There's a ton of inventory that, as I speak with Brad, who will be on my podcast Fun Friday here coming up, just to discuss the marketplace here coming up. A lot of these 80s deals, these 90s deals, these 70s deals, some would call it junkier product, right? That more syndicators were kind of doing. People like us, less sophisticated, of course, that are actually unfortunately going to have to sell here coming up, which could create some sort of market velocity. But it's just a very, very difficult place that we're in right now. And, we're someone who's into the weeds of this. We want big moves to happen for things to be functioning and transactable, but it's just not where we're at right now. And you just have to take what the market gives you. And right now the market's not giving us much to work with.
I think we're also very blessed to not need a transaction.
Yeah.
Would love to do a deal. We have the capacity for it. The team's excited. You're excited. We have a lot of investors.
All I want to do is deals, right? That's how we make the big bucks.
We could raise all the money in the world, but the reality is if there's nothing to raise for, then cool the jets. And so when I say we're blessed and grateful, that's because we have a large enough portfolio to sustain ourselves, sustain the business, and just ride it out until the right time. The worst thing we could do is force a deal that doesn't make sense, because while in the short term the fees might feed you and make you happy, in the long run that could be actually a prison, right? The wrong deal could actually cost you way more money, either truly monetarily or through reputational damage. So that's a constant reminder that anyone in our position needs to be telling themselves in order to really attain that long-term track record that we're seeking.
For sure. And, unfortunately, in the business of it, you make a little money to keep the lights on through the management fees, things like that. But your real money comes at, realizing the profit of these deals by the exit of these. So, being disciplined is everything. Picking your spots is everything. But unfortunately, we're just in that weird point of the lull of the market where things are just not really making sense right now. So I just wanted to kind of touch base on that. I've gotten tons of emails over the last kind of 3 weeks. And before that, what are you working on? What are you working on? I wish I could tell you we were in a situation like we were last year. We were working on our first deal in San Antonio, Regency Grove, formerly known as Aspire apartment complexes. And then secondly, of course, Cortland Copperleaf, now known as Preserve. Rob's old home for a stinted period of time there when he was in Houston. I wish we were working on 2 deals like that with very, very attractive going in fundamentals. But cap rates from then even kind of contracted, have kind of compressed. And, the debt market was better. That was maybe the low end of the market at that point, you could argue. But as I said,
think about that. Back then, cap rates were higher and interest rates were lower.
Yeah. So that was really one of the times. So, and you know what? The other thing to think about too is, while we're on the subject, the floating versus fixing conversation. It's just kind of difficult to feel comfortable to lock in fixed rate debt right now at 6.5%. It just doesn't really make that much sense, particularly if you've got conviction that rates are going to start kind of coming down, or even if they stay stagnant, even if it is a higher for longer situation. I personally am cool with buying a rate cap, right? Being in a floating rate scenario where we could actually get the upside of that kind of going down and have a very easy kind of flexibility to exit these deals.
Yeah, that's often left unbaked into the analysis, which is the prepayment penalty, which you just briefly touched on. And I don't want to, we've got an agenda that I want to stay on, but prepayment penalties are a huge part of financing. And it is the biggest overlooked part of financing. Because while it's not an explicit cost to you today, right? The explicit cost to you today are upfront lender fees, it's the interest rate on the loan, but a major implicit cost is the prepayment penalty, because if you do in fact want to sell in 3 years, 4 years, 5 years, and you don't have the right prepayment penalty in place, it could cost you an arm and a leg. So that's another just side benefit without diving too deep into the whole floating rate conversation.
Transitioning to our next topic, staying on schedule here, the one, the only Jay Parsons, who, by the way, if you don't follow Jay Parsons, his podcast, the Rent Roll podcast, if people actually frequently ask, hey, what else should I listen to? What are you listening to? I would say right now, to be honest, Jay Parsons' podcast is really great. Tons of nuggets, very data driven. I'd kind of consider him a data analyst of sorts. But that said, he is awesome. We've had this that we're sitting on for a touch, but Rob, I know you wanted to speak on this kind of right here. So let's get into his post that he had a couple weeks ago, which, of course, if you listen to his show, he kind of talked about there as well. So I don't know if we want to link that. If you want to look it up, just look up the Rent Roll podcast. But that said, this is a really nice sign for what we do. And for investors who maybe are in trickier deals or, maybe have a pessimistic outlook, this might actually flip your opinion.
Yeah. So this is a LinkedIn post by Jay Parsons, who's a multifamily economist. And he talks about, we all know the supply side of the story over the last few years, and that there's been record amounts of supply hitting many markets around the country. So here in his post, it says supply, which hit a 50-year peak in 2024. But he says that absorption is basically right in line with that peak supply. So again, while there's a ton of new product being delivered to the market, there's in some case there's roughly a commensurate amount of demand materializing to meet that supply. Now that doesn't happen uniformly, and it doesn't happen equally across all markets. There's examples across the country where there is in fact a glut of supply, and and there's not enough demand to meet that supply.
Disproportionate amounts of supply in certain areas.
And that's where you see concessions like 1 month free, 2 month free, 3 months free, and you see rents go down, occupancies go down, and those are the deleterious effects of oversupply. However, supply is a cycle, and those sorts of market reactions are cyclical for sure, and demand also waxes and wanes. So what Jay is saying, that even though that I think we're a little bit behind here as far as when the demand's really going to be coming hard back, he's saying that the data suggests that demand is already very strong. It was strong in 2024, and it is projected to be very strong in 2025. And then specifically, he calls out Dallas, Houston, and Austin as the markets that led the nation in apartment absorption. So absorption is a key metric that encapsulates both supply and demand, right? So it's really the most important thing that you're looking for, because if you only talk about one, you miss half the picture. And so here we are talking about how Texas alone accounted for 18% of the national total of absorption. 61% of all net new apartment households went to the high supplied Sunbelt or mountain regions. So while there's been kind of this talk of, Texas or Phoenix or, the South, it's like a boom bust, and, it's had its time, and then now its time is up. And then the Midwest was seeing positive rent growth while the rest of the country was kind of negative or flat. Well, I think kind of that was a little blip in time. And I think things are going back in favor of these high growth, yes, high supply, but higher growth Sunbelt markets like Phoenix, like Texas, like Atlanta, the Carolinas, Florida. So, and this data bears that out.
So for those who invest with us and who will continue to invest with us, it's no secret that Houston is our flagship market for now. That could change, of course, as time progresses. But this is right here, some high-level metro area at the bottom part of this little part. So I'm going to try to read it a touch for you. But 3 markets where demand exceeded supply by a wide margin. Good side of this right here. Washington, D.C., Houston, and Las Vegas. Awesome. And then on the flip side of that, where absorption was not as good, Phoenix, Jacksonville, Seattle, Philadelphia, and Dallas. Interesting. So that said, We do feel that rent growth will not be negative this year, maybe a percentage point up, but the bleeding is not really there in Houston. And then, of course, it's been documented that we want to expand more in Dallas. We are very comfortable with Dallas long term. We've got a couple projects there, a couple properties there, of course. And then Phoenix. Phoenix is obviously experiencing a tough go of it right now, but we're very excited to get into that marketplace for obvious reasons. It's very complementary to what we're currently doing. There's certain areas that have got worse kind of fundamentals there. But all in all, we are very excited about what is going to come up here in the future there in Phoenix. Long term, we're very bullish on it. There's great migration trends to that area, and things go in cycles. Obviously, it's nice to not own any product in Phoenix right now. Funny enough, I just drove by a property. I just had a great lunch with some capital raising friends and people in the space. So a little kind of a luncheon, kind of a meetup and note trading process there, if you will. And I drove by a property really close by to where lunch was, ironically. And it's a 70s vintage asset property, and it's offering a 3 months free of rent. Pretty tough if you're an owner there. That's really challenging. So 3 months free. Not only that, but they probably have to drop rents to even be competitive in the marketplace. So someone is probably on the wrong trade of that. That's a very challenging thing to work out. How it gets worked out, well, these things move slowly. No one's really in a rush to realize a loss. People are always trying to wait in hopes for a better day. There's several deals that we're bidding on right now, and we were bidding on in Q4 of 2024, in which if they had sold to us at that time, it would probably have behooved them. Unfortunately, they did not accept our offers at that point. And now our offers are going nowhere but down. So unfortunately, for people to make money in this space, for kind of cycles to happen, someone has to be on the wrong side of a trade, and we're seeing a lot of that kind of unpack right now.
And that, just to clarify, also is specifically related to, we'll endearingly refer to it as junk, like you talked about earlier. That's the older property. That's the syndicator type stuff, workforce, 80, 70 stuff. That stuff, as far as pricing, that's not going anywhere. It's not going to necessarily take off and double in value, and you're going to miss the boat. However, the new end of the market, high quality construction, newer assets, good locations, that stuff is already pricey, and it's been pricey. There was a blip in time kind of a year ago where it felt a little cheap for a second, but the bid came back, and then things are competitive. It really only takes a handful of buyers, like 2 buyers, to create an efficient market and for there to be a bidding war. So that's just the clarification, because people might hear like, oh, well, didn't you guys call the bottom happened a year ago? And we say, yes, but for the right assets. For the less desirable assets, that stuff's going to languish, and it's going to be there, and it's probably not going to run from 70 a door to 120 a door in a hurry. So at least we don't think so.
Basically, a couple of factors need to happen for these junkier product properties to come back. One, the bleeding needs to stop, aka new supply needs to stop coming online. Jobs need to be a little bit more robust. Wages probably need to go up a touch, but there just needs to be a stop in the bleeding, economically speaking, and for more productivity to happen, and for basically the economy to overall function a little bit better. And that's going to take some time. Trump will come in. There's people, as you mentioned beforehand, that are excited, but he cannot just snap his fingers and kind of unwind kind of the economic downturn that we've experienced, or lack thereof growth here coming up. So it's a tough place to be in right now. But what is good right now is 2 things are very deflationary, and inflation will cause rates to go up, but for rates to go down, things need to get cheaper, right? Well, 2 things that are heavily deflationary is cost of gas, cost of oil, goods will go down, fuel, things of that nature. That's going to start going down as America gets more energy independent. And then, of course, what is also deflationary? Well, cost of living going down. What do I mean by cost of living? Your rental pricing, things of that nature, apartment complexes going down. So those 2 things right there are heavily deflationary. That should help a downward pressure on rates.
Very true. But I would go back to your point about what's going to save these properties or make them go up in value a lot. I would say it's less about the fundamentals. I mean, yeah, supply, sure, and that, but that's all going to happen. But what those properties really need is a wave of capital to go and chase deals, because right now there's only so much capital chasing deals, and because there's a select group of capital out there, it's taking the pick of the litter, and it's buying all the nicer stuff and ignoring all the worse stuff. So what you need is a situation where interest rates are zero and everyone has to buy at any price. They don't care. They just say, I just need to get in. I don't care what it is. I don't care where it is. I just need to get in. And that's where you're going to see the bottom of the barrel assets go crazy in value. So until there's that euphoria, you're not going to see those properties be priced kind of out of alignment with fundamentals. So that's going to take quite a while.
Yeah, I mean, there's going to be a touch of a depression of sorts coming up here that is going to be very challenging, and it sucks. And if you're an investor and you've invested a lot of product, there's a very good chance that you've been in those deals. And it's not a fun time, but it's also a very fun time, paradoxically, because you can make a lot of money as an investor during these opportunities. So, glass half full. Keep investing, dollar cost average, and hopefully you'll shape your decision making future differently when you invest when the market gets hot again. We certainly will kind of consider things differently when the market gets hot coming up, but that will be a while from now before it gets white hot like it was before.
Yep.
Very excitingly, Rob, we were on, a Zoom call probably at the start of this month. And lo and behold, you kind of created a new, I wouldn't say product, but a new kind of guide, a new model, if you will, based off and built off of what you've historically done, which is a fund-to-fund toolkit. So if you wouldn't mind maybe sharing your screen, if you wouldn't mind kind of discussing kind of the purpose of this, what it's for. But as many people know, it's been well documented that the fund-to-fund is kind of the latest and greatest from a compliance perspective to raise capital. So naturally, Rob is very, very very, very much so, spent hundreds of hours creating his underwriting model, maybe thousands. I don't want to undersell your work there. And what this is kind of a plug on, an add on, if you will, for the fund to fund process for you to help understand, the compensation structure for fund managers and opportunities. So if you wouldn't mind pulling up the fund to fund toolkit, and then also what is there. I mean, this is something super exciting. I'm getting tons of downloads. I'm obviously seeing from my end, but this should be very exciting if you're kind of a capital raiser, fund manager who likes modeling and stuff. A lot of people actually don't even have this kind of worked out in their systems that are other sponsors, which you probably want to work with sponsors like us who think about you, the capital raiser, very much so on top of our mind.
Yeah, so I don't want to share my screen because I've already done all that hard work. I've recorded a video. It's all available for everybody. So if you, after I explain all this stuff and you're interested in actually diving in, getting your hands on this and the video that was recorded, just head over to our website, lscre.com. And then right there on the homepage, you'll scroll down and you'll see the Fund Manager Toolkit download. So when you download this toolkit, it's going to come with, we want to give you all the goodies. So it has our underwriting model that we use in-house to analyze deals every single day. It also has the brand new, oh, here we go. Here's the beautiful website. There's the Fund Manager Underwriting Toolkit. So with the underwriting model, like Craig said, there's also the Fund Manager module, the fund-to-fund analysis tool. And so what this does is it allows you to take any underwriting. So it's not necessarily a deal with us. You can look at any deal that you're looking at raising capital for, and you can take out the cash flows from that deal, plug it into the fund-to-fund analysis, and you can do a double waterfall analysis where you can put in what your fund's preferred terms are, and then you can model out what terms you should set up for your fund to fund, and then you can model out, okay, here are going to be the fees and the promote that I'm projected to earn in this fund. And so that way you can get a sense of what is your compensation as the fund manager for this deal, what do your investors that you're pooling into this fund to fund stand to make from the deal, and just to make sure that all the boxes are checked, that the deal is fair, the sponsor is providing good terms to you, they're getting good terms from you, and your investors are getting good terms as well. So sounds a little complicated, but we try to make it really simple. It's simplified down. So there's great resources there. And like I said, I recorded a 30-minute video doing a full walkthrough as to actually how to use the spreadsheet. So go ahead and give that a download. Check it out. And if you have any questions, just reach out to us. And whether you want to use that resource to learn more about partnering with us or partnering with anyone else, it works just the same.
Yeah, our goal here with something like this, and just generally speaking, is to give you as much information as possible to make good educated decisions. But also, we want to be very thoughtful and streamline the process to have you work with someone like us. So basically, creating systems, processes, and in a world in which you could seamlessly learn about us, work with us, have our information, help you kind of better understand the landscape, and something that's probably a little bit confusing to start. Is kind of the goal. So super happy that we created that. We quickly implemented that system into our website, and I think it'll be very useful. I think you're going to be touching on that too during the Raise Fest, the presentation. Is that correct? Or
Yeah, I'm gonna have to update that and get that prepared. But I was
yeah,
just on Axel's podcast and I was sharing about the Fund Manager Toolkit. So I'm gonna be doing some podcasts and sharing more about that. And we kind of mentioned this at the end of this podcast, but definitely next episode we should also spend some more time, talking about this in the intro. Really get people jazzed up about this.
yeah, a little call to action as they call it in the business, right? Well, any other final thoughts? No need to speak forever here. Very tight on the show. Any final thoughts, Rob? You've got anything on your mind that you'd like to speak on?
Yeah, actually, I do have a topic in mind that I'll probably record a solo video on, but we can talk about it now or a future
Yeah,
podcast.
yeah.
But
Give a little sprinkle. Give a little
yeah, I just
crumble.
want to mention what's on my mind. I just conversation was having with Brad the other day about the value add cycle, and everyone was doing value add, and everyone couldn't get enough of value add, and it's an interesting thought because then towards the end of the cycle, everyone started making jokes and complaining that, oh, well, this deal's been value added 3 times in a row. Buyer bought it, they renovated it, raised rents $100, then they flipped the deal, then the next guy bought it, did renovations,
It's hard
raised
to have
rents
three
$100.
doubles in one cycle, right? It's quite challenging.
Yeah. And so, what is, I just want to kind of put my thoughts out there a little bit. So, in order to do a value add, you have to have capital, right? You're going to buy a property. Okay, it takes capital to buy the property. Then you're actually going to put money into the project. That takes more capital, right? Let's say you're going to spend $10,000 per unit on a 200 unit property. That's $2 million, right? So that's takes more capital to do a value add. So it's capital intensive. It also is an optimistic bet, right? You're going to not only buy this asset, you're going to pour money into the asset because you have the confidence that you're going to be able to actually raise rents and get those rents and get people in there and pay. And that cycle works off of optimism. And then that optimism tipped over into exuberance. And that's kind of how the cycle goes. And then we all know what happens after exuberance: depression, right? And so after you have the high, you have the low. And so in the low period, everyone is either without capital, so they own a property and they don't have money for they can't, even if they thought they wanted to put the $2 million in to renovate and raise rents, they don't have the 2 million. Not only do they not have the 2 million, they don't have the money to pay the bank. So when they don't have when they don't have the money to pay the bank, guess what they stop doing? Curing deferred maintenance. So what starts accumulating?
Deferred
Deferred
maintenance.
maintenance. And then their occupancy goes down, and then it's a vicious cycle. And then before you know it, that project went from a stable asset, whatever, maybe it was ready for value add or not, but by virtue of the capital destruction cycle, now that property perhaps is in disrepair, it's in physical distress, it needs curing of deferred maintenance, and before you know it, the value add cycle starts all over again. Now, someone is the first one to become optimistic again and go, you know what? I could buy that turd. I'll remediate the mold. I'll kick out the bad people. The down
Slap a paint
units,
job.
yeah, the down units that are missing appliances and stuff and the roof leaks, I'll fix all that. And then I'll bring the rents back up to normal and I'll make a killing. So it takes the first optimist to kind of get going and then before you know it, you're on that value add cycle again. So it's just an interesting thought because one could imagine that, oh, wow, isn't just every property at this point value added because there's just been so much capital poured into all these deals? And it's true. But then for the last few years, we've been in the value or capital destruction process where, it's just been trickling down by virtue of people, being in financial distress, which then leaks into physical distress. So yeah, that's just been on my mind. That's a video that I want to make, but just an interesting thought to share with listeners today.
So, and I've always said this too, there's just very hard to actually find a good opportunity where there's a return on cost story, meaning, you put a dollar in and you hopefully get $1.20 back, right? That's kind of the goal by any flipping. Value adding is no different than home flipping or anything of that nature, right? ARV, good stuff like that. Very simple, fundamentals there, if you will, right? The thought though is how many deals were value added through the cycle? How junky is it? But what does it look like? When do the value adding opportunities get hot again? Is it a decade from now? Is it 5 years from now? Is it less? Like, what do you kind of forecast here? Pull out your crystal ball one time for us.
I think we're getting there. I think we were looking at a deal. Brad and I were in San Antonio yesterday, and this deal, it's just languishing, and it comes back around. It went under contract. It fell out. Every time we look at it, we continue to offer a lower price because it gets in worse condition. It's just continuing to be neglected. And so, yeah, the value is just being destroyed there. And so it's ready to go. If we were to buy right now that deal, it would be ready for value add. We would be able to go in there and clean up a house and raise occupancy, raise rents, essentially raising NOI, and we would be able to get a solid yield on cost. It's now. The opportunity is now. What is not quite here is the pricing, because that seller is not ready to let go of that deal at a price in which we would be willing to go and take on that heavy lift project. Now, maybe we aren't the market clearing price because we have higher standards, because we don't really want to buy a junky deal unless we're really getting paid for it, because we would just rather buy nicer, newer product. So we're not necessarily the market clearing price, but we're an example of the market dynamics and what needs to happen in order to actually make these value adds feasible again. So it's the physical opportunity exists as far as, okay, you put money into the deal and you'll get NOI out. And then secondly, the pricing, right? There's no reason to pay stabilized pricing for distressed deal. So it's just that seller just needs to get burned one more time with another buyer to fall out of contract, to finally go to a group like us who says, hey, I have certainty of closing, but my price is going to be a painful one.
Yeah, no one's really in a rush to lose money, and everyone would rather probably roll the dice a couple of times to work with maybe a flakier sponsor who's trying to get a deal done, in efforts to close. But eventually, you run out of time, you run out of options, you run out of money, you run out of everything that you need on your side that would give you leverage, and you eventually, of course, capitulate to whatever the market bottom looks like, unfortunately.
Yeah.
And that's kind of the point we're coming close to here. Also, value add doesn't necessarily mean that you're also, and just kind of a misnomer here, something that I was thinking of when you were speaking, was value add doesn't necessarily mean, hey, I'm going to paint everything white and put a dolphin gray toned flooring on the bottom. It could also be, occupancy issue, outside exterior deferred maintenance stuff, management problems, things of that nature, where you could still get a value add return, which is somewhere between, call it a 14 to an 18% IRR. So there's multiple ways to skin that cat. Excellent. Well, excited we had another show here on a Friday. Nonetheless, this will be coming out on Monday. We appreciate you listening. Once more, referral reward program. Email me if you want any more information there. We'll be sending out, of course, emails here next week or the following week with regard to meeting at RaiseFest and the Best Ever Conference. We are looking forward to seeing everyone in person. Big events coming up here. A lot of buzz in the air. A lot of things happening in the market space right now. Lots of carnage really coming underway, particularly when the debt market is where it is right now. Tough times. But if you listen to this podcast, we hope you get a little bit smarter and a little bit richer. So thank you so much for listening. We will see you next week.